Folks, Dan Frio here with your market update for July 10th, 2024. So today we're going to have basically an economics lesson on the deficit. And before you turn the dial, let me explain what I'm going to talk about. How the deficit that we're facing right now is going to hold interest rates higher for longer. It doesn't matter what the Federal Reserve is going to do. Now, I'm not saying the rates are going to go up from here. What I'm saying is, well, let me explain. Well, first thing is, these are the top 6 programs people use when they're buying their first house. Okay, so we'll get to these in a second. What I want to go over through is right through here, the national deficit that we have. Here's the concern. Why the deficit matters. The federal deficit and debts are concerning for the, hold on, I got to put my glasses on. I'm an old fella. For the country, because the majority of the national debt is held by those who purchase Treasury notes and other securities. A continuous deficit adds to the national debt, increasing the amount of securities that they need to hold. The concern is that the country won't be able to pay its debt off. Debt holders demand higher interest rates to compensate for the higher risk when that happens. The increases the cost of interest rates and causes a recession. So what we're seeing right now is this. Here's our deficit. And guys, I'm not going to complain about Biden or anything else right now. I just want to show you the facts. Here's the deficit. Okay, so why do I bring this up? Well, a lot of people don't understand how this works. So let's go over to here. Here's the 10-year Treasury. This is a Treasury bond. This is basically what the federal government issues when they have a deficit, meaning they're spending more money than they're taking in. And I'm going to show you a clip here in a second. Well, let's go over to this clip. You're going to understand this. Then we're going to come back to this. I want you to see this video. Now, I get a kick out of this guy right here, John Kennedy. He questions people in Congress, and it's hilarious. So take a look at this. This is what the federal deficit is right now, and this is going to play a key role in where interest rates go from here. So let's take it away. It's going to be it's about 5 minutes. So pay attention to that. When we come back, I'm going to show you how this is compounding into the effects that we're seeing right now, and we're going to continue to see with mortgage rates. So, Mr. Kennedy, take it away, my man.
Thank you, Mr. Chairman, Mr. Director. Welcome. Mr. Director, what's the national debt right now?
Well, it's we project at the end of this year, it's going to be over $28.1 trillion.
28 trillion. What percentage of GDP is that?
It's just under 100%.
Could you speak into the mic and repeat that?
It's just under 100% of GDP.
Okay. 100%. And for this current fiscal year, will we have spending deficits?
Yes, sir. We're looking at about a $2 trillion deficit this year.
And that means that we've spent $2 trillion more than we took in, right?
That's right.
So we've had to borrow money.
That's right. That's right. The debt is going up.
And so that money that we borrowed increases the amount of national debt, doesn't it?
That's right. And it means more interest payments, which then goes back and means more debt. So there's a negative cycle attached to it.
Okay. So our current national debt is over 100% of our economy. It's $28 trillion. Mm-hmm. Let's suppose that we think in 10-year windows, as you know. Let's suppose nothing changes over the next 10 years. Nothing. We don't renew the tax cuts. Nothing changes. Mm-hmm. What's the debt going to be 10 years from now?
Right, so our projection is then over $50 trillion or over 122% of GDP.
It can't be sustained.
Well, damn, looks to me like we better do something. I mean, we can sit here and debate the tax cuts and you talk about the tax cuts don't work. I don't know how you know that because the pandemic skewed all economic results. But we better do something, huh? Do you think we can sustain the spending?
No, the risks are mounting with higher interest payments and higher debt. And that's, as you said, that's why action must be taken.
So what should we do?
It's, the sooner Congress acts, the easier it will be.
I get that.
It's not
so what
easier.
Should we do?
I'm here to support you,
talking points.
But not to tell you what to do. I mean, reduce the deficit. You have choices. You can look at mandatory spending on the spending side as a driver. You have healthcare costs and Social Security. On the revenue side,
Well, let me stop you for a second. Everybody always says that mandatory spending is driving the cost, but and they say, well, look, we've got to do something because the Social Security trust fund is going to run out, and Social Security is going to be automatically cut. Look me in the eye and tell me you really think the United States Congress is going to allow Social Security to be cut.
I would expect some action to be taken before that happens.
So if you think the United States Congress is going to sit here and allow Social Security to be cut, even if there's not a penny left in the trust fund, you've been dipping into your ketamine supply. It is not going to happen. We'll just go into the general fund and take the money, won't we?
Right, and that would add to the deficit as compared to current law.
So why do I get it? We make these distinctions between mandatory spending and discretionary spending, but it's really out of the same pot.
That's right. There's just one general fund of the Treasury.
Okay, so one option is to reduce our spending, correct?
That's right.
What if we cut our spending 1%? 1%. What if we turned to every single department head in the federal government and said, next year you're going to cut your spending 1%. Not 5%, not 4%, 1%. Something families who are living under Bidenomics, which is defined as paying more to live worse, something families have to do every day. What would be the impact of a 1% cut by every budget officer?
Yeah, so outlays next year are going to be just under $7 trillion. So 1% of that is $70 billion.
What we did 2%? What would be the impact?
Yep, there'd be $140 billion. And that's the challenge, is that the deficit is so large that, that what you're saying, makes a difference, but is pretty modest relative to the size of the challenge.
What do you
Okay, so they continue to go on. What if we go 3-4%? The gist of this is, now you see why I'm complaining about all these giveaways. We don't have the money as it is, and we keep giving all this money away. Okay, so let's go back to this. Let's see the deficits that we've seen in the last, let's say, 10 years or so. Here's the deficit chart per year. Okay, you go through 2012, this is it, and so forth. Then you go down through here and look at these numbers through here, okay? Why is these so much bigger than, this was COVID right through here, okay, right through here. And then we continue to see those. So not complaining, it's government in general. They recklessly spend. So what's happening right now, let's go back to this chart. Let me let you understand this. If you have more of something in the market, like he was saying, we're going to be flooding the markets with Treasury bills, okay, because the national debt it can't be sustained. This is where Treasury yields are. Okay, so when they're selling bonds, or when the government has a deficit, they have to sell bonds. Well, what they were saying is the more and more and more bonds you issue, the more risk there is. So you need a higher interest rate. That's why this is going through. So this is the 10-year Treasury. Okay, look at the yields since 2019. Up and up and up. This is also the reason why mortgage rates are up. So because they compete, mortgages are based on a mortgage bond. So let's go over to the mortgage bonds. Here's where the mortgage bonds are. So if you see this, it should have somewhat of a correlation with, let's see, this is basically inverse. So what happens here is when this number goes down, it's kind of the same as this number going up, because this number represents the price of the bond, and this number over here represents the yield. Why they do that, I don't know. Okay, so it's the same thing. So you're seeing through here, the price of the bond went from here all the way down to here. What do we know about mortgage bonds? Well, as the price goes down, rates go up. So if we're flooding the market with bonds, treasuries, and mortgage-backed securities, there's too much for the investors to buy. So they're demanding higher and higher and higher yields. So even if the Federal Reserve comes in and starts reducing short-term rates, I don't know how this is going to pan out unless the federal government stops spending so much more, or so much more they don't have. Okay, so that's basically a breakdown today of how the bond market's reacting to a lot of this. When I was a kid, I never cared about this. I heard it all the time. Oh, there's a deficit. But as you get older and you realize these things, Guys, this can't be sustained. You just heard it from the current administration's financial people that it can't be. Something has to be done. And they always go back to, well, we're going to cut Social Security. We're going to cut. They're not going to cut Social Security. There's money there to be used somewhere. Okay, it's all the little perks, and I have lost a lot of viewers to my channel when I'm complaining about student loan debt forgiveness and all this other stuff. The main purpose of this, guys, I'm not out there to hurt you guys. I'm out there to make sure our country is solvent. Okay, and we can live a prosperous life. That's the whole point here. And if you want to buy real estate, you don't want to buy real estate, you have to focus in on the economics of the country because, we're going in a bad direction. Okay, it's going to get to the point where nobody can afford homes. So are you going to be on a side of the equation where it's corporations and the wealthy owning all the real estate? I don't think you want that. Okay, so there are parts of the country that are affordable. If you're out there and you're on standby saying, okay, rates are too high, I'm going to wait for them to come down. I don't know how far they're going to come. I'm waiting for that crash. Unfortunately, there's not enough supply. There's not enough dynamics in the economy right now to cause housing to crash. Now, will it correct a little bit? Yeah, certain areas, and I've been saying that for 2 years. You have Austin, it's going to correct. You have many parts of Arizona, going to correct. Florida's going to correct for sure, and they have more and more problems other than just, the real estate down there. It's taxes, insurance, and everything else. Same thing with California. But the middle of the country, it's very much, I won't say very affordable, but it's much more affordable than a lot of these boomtown areas that really saw huge appreciation and growth during COVID. So that's my point of today's video. I want you guys to understand the dynamics behind the government's reckless spending right now. It's not a joke. Look at this number here. It's going to be $35 trillion. Think of you getting a credit card statement saying, well, you're $35 trillion in the hole on your credit card. You'd lose it. Okay, so that's that right now. Right now on the bond market with mortgage rates, let's see where mortgage rates are right now. These are the top 6 programs people use when they're buying their first house. It's not my rates. These aren't any individual rates. What happens is Mortgage News Daily surveys lenders all over the country. They ask them these 5 questions. If you're buying your first house, it's going to be a single family home and you're going to live there. Okay. The other 2 criteria of this is you're putting down 25%. You can see that right through here. And you have a 780 credit score. So if that's you, well, that's your rate, most likely. Okay. If that's not you, what rate can you get? Well, reach out to us. We would love to help you. My name is Dan Frio. I do this report every day, but I am a loan officer licensed in all 50 states, as well as Puerto Rico. I'm set up with my bank, which is Serve Bank, but we're also set up with about a little over 40 different lenders. They're banks, credit unions, just lending institutions to be able to offer you their programs, their products, and their rates. Okay, so instead of you shopping around like you used to do in the old days, going to 50 banks and getting pre-approvals, checking rates and everything, this is what we can do for you here. Just with one application, one credit pool, and we're going to get you approved and then search you over probably close to 50 different lenders to see what rates are out there and what's the lowest fees we can get you. But if you're looking to buy your first house, check out the grant finder right here. A lot of people are missing this. And then when we get applications in, I run it. I'm like, hey, congratulations. You qualify for a $6,000 grant. And they're like, we didn't know. So check out the grant finder first. If you're in Illinois, we just launched a $10,000 down payment assistance grant if you're in the Chicagoland area. So check out my video that I did yesterday right over here. So if you're out there and you need some assistance, maybe buying your first house, maybe buying your second home, maybe pulling equity out of your current house to buy a second home, maybe refinance, even a reverse mortgage, we'd love to help you. Go to therateupdate.com. Here it is. If you want to put in your application, you can do that right there. Or if you want to give us a call or email me directly, you can do that as well. You scroll right down to the bottom of the website, and there it is. Thank you so much for watching. I'll be back later at the closing bell. Take care. Have a great day. Bye-bye.